Hey everyone, welcome back to Corporate Decoder. Today, Overland Advantage just filed their 10Q for the first quarter, and I'm seeing some significant shifts in their debt and investments. Quick note, this is not financial advice, just my take on public filings for educational purposes. Their loan portfolio has grown rapidly, but their borrowing costs are climbing fast too, setting up an interesting dynamic to watch. Let's dive into what Overland Advantage reported for the first quarter of 2026. Looking at their balance sheet, we see total assets were about $1.6 billion. That is up from around $1.59 billion at the end of 2025. On the flip side, their liabilities also saw a jump, mostly due to more debt. Total liabilities stood at $869.8 million. An increase from $861 million. This means they are using more borrowed money to fund their operations and investments. Their net assets, which is essentially what is left if you subtract liabilities from assets, were $736.2 million, up slightly from $732.3 million. Now let us look at how they made and spent their money. Just for the 3 months ending the 31st of March 2026, Overland Advantage reported total investment income of $35.2 million. This is a big leap from $18.7 million in the same period back in 2025. This jump comes from the interest income generated by their investments, showing their portfolio is growing and earning more. However, their expenses also went up substantially. Total expenses were $19.2 million, up from $11.2 million in 2025. A major part of this increase is due to higher interest and debt financing costs, which rose from $7 million to $11.5 million. This highlights the growing cost of their borrowing. After all expenses, their net investment income was $16 million. A nice rise from $7.5 million in the prior year. However, they also reported a net investment loss of $3.6 million from changes in the value of their investments, leading to a net increase in assets from operations of $12.3 million for the quarter. This is where things get really interesting. Let's look at where Overland Advantage is putting its money as of the 31st of March 2026. Their total investments, excluding cash equivalents, were valued at a little over $1.5 billion. The vast majority of this, about $1.39 billion, is in first lien senior secured debt investments. That means they are lending money to companies and have a primary claim on those companies' assets if things go wrong. Their weighted average yield on these first lien investments is a solid 9.57%, which is pretty good. The rest of their portfolio is spread across second lien senior secured debt and unsecured debt investments. The shift in their portfolio is noticeable compared to the 31st of December 2025, where their first lien investments were valued at $1.2 billion, showing a clear focus on growing these secured loans. When valuing their investments, Overland Advantage categorizes them based on how easy it is to determine their price. Most of their investments, about $1.51 billion worth, are considered level 3. This means their value is based on unobservable inputs, like what the company's management thinks it is worth because there isn't a ready market for it. Only a small portion, $9.6 million, falls into level 2, which uses observable inputs, and nothing is in level 1, which are prices from active markets for identical assets. This heavy reliance on level 3 valuations means their reported asset values depend a lot on management's estimates, which can introduce uncertainty. Now let's turn to how they are funding all of this. As of the 31st of March 2026, Overland Advantage had significant borrowings. Their MIS revolving credit facility has a total committed principal of $300 million, with $195 million drawn. The interest rate on this facility is tied to SOFR plus an applicable margin, and it is scheduled to mature in February 2029. The cost of borrowing here is significant, and they have a lot of this facility still available for use, which points to their strategy of using leverage to expand. Then there is the SMTB credit facility, which is quite substantial. As of the 31st of March 2026, they had $500 million drawn. This facility has a revolving tranche and a term loan tranche. The revolving tranche had $227.3 million drawn, and the term loan tranche had $272.5 million drawn. The interest rate here is also tied to SOFR, but the terms and margins have been adjusted multiple times, indicating active management and possibly pressure to secure funding. This facility matures in April 2027, showing they are actively using debt to fuel their growth. They also have the BNP revolving credit facility too, with a total committed principal of $400 million, and they had $146 million drawn as of the 31st of March 2026. This facility also has floating rates tied to SOFR and matures in December 2030. This shows a pronged approach to their borrowing, using different banks and facilities to manage their capital needs. Looking at the company's portfolio composition as of the 31st of March 2026, their total investments were valued at over $1.5 billion. What is particularly noteworthy is that 17.1% of their portfolio, or about $259 million, is rated as a 3 in their internal risk rating. This means the borrowers are performing below expectations, indicating an increase in risk since the loans were made. This is up from just 8.5% at the end of 2025. While their overall portfolio yield is still decent at 9.68%, this growing number of higher risk internal ratings warrants attention. When we look at their expenses, they are significant. For the first quarter of 2026, their expenses before any support from their advisor amounted to 9.73% of their average net assets. While this decreased slightly from 11.46% in the first quarter of 2025, it still represents a substantial cost of doing business. They are getting some help from their advisor though, with expense support reducing these costs to 9.42%, showing the advisor is actively managing their operational costs. Despite the high expenses, their net investment income to average net assets applicable to common shares was 10.04% for the first quarter of 2026. This is an improvement from 8.19% in the same period in 2025, indicating that their growing income from investments is outpacing the rise in expenses to some extent. Finally, let's consider their net asset value per common share. At the end of March 2026, it was $24.58, down slightly from $24.69 at the end of December 2025. This small decrease in net asset value per share, combined with a steady increase in the number of shares outstanding from debt issuances and reinvested distributions, suggests that while they are growing, the value per share is not significantly increasing. This is common for companies that rely heavily on debt financing and aim for steady income generation rather than explosive growth. So what is my take? Overland Advantage is clearly in a growth phase, aggressively deploying capital and using debt to do so. The higher interest income is positive, but the rising cost of borrowing and the increasing proportion of internally rated higher risk loans are key areas to monitor. The fact that most of their investments are valued using level 3 inputs also adds a layer of uncertainty. It will be crucial to see if they can continue to generate enough income to cover their growing debt expenses, and if their internal risk management is effective in navigating this investment landscape. Alright, that is my breakdown of Overland Advantage's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hit that like button and subscribe for more deep dives. The scanner and broker I use day to day are linked below. Grab a free sign up if you want to support the work. That is my take. Stay decoded.